Everybody, how are we? Good evening. I've not done one of these for a while, but I thought it would be useful to just jump on and answer some questions for people. Over the last 2 weeks or so, I've gained a lot of new subscribers. I don't know why. I don't know whether it's the YouTube algorithm just being useful or people who just like more of the videos that I've done. I have no idea. But whilst the channel has kind of taken a bit of a boost, I thought it'd be worthwhile just doing one of these to help some of the new people who may have not joined one of these live Q&As before, and to maybe just reintroduce myself as well and let the newbies know who I basically am. I know that there are already some questions in the comments already. Some comments in here. Well, there's one about property prices, and so we're going to give this a solid 45 minutes. Let me just double check and just make sure. I was doing something before this, guys, so let me just make sure that I just want to make sure that all of my audio channels are correct. All right, so 45 minutes. So we're going to have until 8:45, essentially, and I will take as many of your questions as possible and try and deliver as much value as possible. Look, I don't give direct advice here. Yes, I'm a qualified financial advisor. I'm a qualified mortgage advisor. I don't practice doing either of those two things anymore. But when I answer questions in sessions like this, what I try to do is give you some things to consider, or things that I would definitely be considering in trying to maybe recommend a solution or put together a solution for someone who might be my client if I was still advising. So that's the whole idea behind these Q&A sessions. It's not to give you the definitive answer. It's to give you a point of which you can do some further research to help you get to a decision. So hopefully that will be useful. I know that for many people who have done and attended these previously, it's always been helpful. I normally use my iPad, but for somebody's going on with my iPad right now. It was full yesterday. It's completely dead now. So I normally do some scribing, which I can't at the moment, but hopefully they'll be as clear as possible. All right. So all by design here is asking, and I can't bring this up because he already put the question in prior to the live starting. He said house prices in 6 to 12 months from now. This is a conversation that a lot of people are having, and this is a common question, I guess. I had lunch with a couple of friends this afternoon, and after about an hour or so, a couple, 90 minutes of just catching up and stuff, we turned to mortgage questions and stuff as well, because obviously they have mortgages. So, house prices 6 to 12 months from now. Now, look, the OBR, the Office of Budget Responsibility, are forecasting that house prices will fall 9% in the next year. So that's through 2023. And they're forecasting that property prices or house prices won't return to the current levels until 2027. So technically that gives us, 3, maybe 4 years of suppressed housing prices. And for many people, if you're looking to buy, and I talk about this in the podcast tomorrow, so I go into pretty much a lot of in-depth about this on the podcast tomorrow. So if you're not tuned into the podcast is on Spotify. It's on all of the good the outlets. It's on Apple Podcast. It's called the Conversation of Money podcast. Go check that out tomorrow morning. But high level, there are a few things to bear in mind. Anyone who says that they know exactly what's going to be happening with property prices and how much it's going to fall by doesn't know what they're talking about, and they'll be lying if they say that they know for sure. I've seen ranges from 15% to 35% to 50%. People saying that this is going to be the worst crash in history. We don't know that for sure. I think based on what we know with interest rates, they are going to continue to increase through next year. We are going to see the property market contract. We are going to see house prices fall. So a prime example, one of the guys who was at lunch this afternoon, he's just separated from his partner and he's looking to buy a new house. Now he's already seen like a 30,000-40,000 pound drop in the house that he was going to buy just literally 2.5, 3 months ago. And he's taken advantage of that because he's like, okay, at least I've got 30-40K in my pocket that I previously didn't have. And so for him, he's like, I'm going to press the button now because of this equation that, you've got interest rates that are going to keep moving through 2023. And I think for a lot of first-time buyers, if you're a first-time buyer, you're caught between a rock and a hard place. You're caught between property prices properly falling and then mortgage rates increasing on the opposite side. The question is, if property prices fall, at what point do they need to fall to counteract the increase in the in the interest rates. The reality is we don't know how far on either side house prices are going to fall or interest rates are going to increase and therefore mortgage rates. And so what I'm saying to people is this: look, there are numbers behind this 100%. And you need to understand the numbers. You do, so that you can understand what the situation means for you. But more importantly, I think you have to tune into the psychology of buying your first home, if it is your first home, and the peace of mind that you get. And if you haven't moved into your first home, it might be a little difficult to understand. But trust me, when you move into your first home and in your head you have this, it's almost like peace of mind, right? Because now you know for a fact that your rent isn't going towards somebody else's mortgage, and it is your house. It will continue to appreciate in value. And yes, you might buy it, and then the value might fall by 5 to 10%, but that's irrelevant because you're probably going to be in that place for 5, 10 years, and in 5 years' time, you should see recovery. So I don't know what's going to happen with the house prices in 6 to 12 months. I think they will fall for sure. I think they will. But then again, when you think of the UK property market, it is notorious for not doing what everyone thinks it's going to do, because the fundamental equation around supply versus demand still applies. There are too few homes for the demand that we have. And you just need to have a look at transaction numbers. So I mentioned this on the podcast tomorrow morning. I was doing a bit of research for it, and this is in an article by one of the companies that actually looks at transaction numbers for property, right? So in October, so this is last month, property transaction numbers were 110,850. That's 9% up on October 2021. And October 2021, we hadn't yet seen the first Bank of England base rate increase. Now, there are a number of reasons why it might have jumped 9%. I would say predominantly because people are fearful of interest rates increasing to the point where actually the mortgage becomes unaffordable. And when lenders start to tighten their mortgage affordability, that also prevents people from getting onto the market. That could suppress property prices. There are so many things, but I talk about a lot of it in the podcast tomorrow morning. Maybe go and have a listen to that. Right, let's see what else I've got here, because there's lots and lots of comments that are coming in through here. So let me just see if I can catch up with myself. There was one other question before. Okay, someone's saying here, with many analysis saying that the S&P 500 could go as low as 2,900 next year, would it be a good idea to cash out and wait to buy at a better price? No, because if you're already in, you're going to cash out at a loss, and you're going to buy in waiting for it to go back up. Why cash out in the first place? It doesn't make any sense. If you bought something for 50 quid, are you going to go sell it for 25 quid, then get back on the market to exit at 50, 60 quid? You exiting right now makes zero sense whatsoever. So if you are in the S&P 500, keep your money in there, leave it. If it recovers, great. Maybe what you want to be doing is, if it is low right now, you should probably be buying more. I mean, it's human psychology, right? This is what we always do. We cash in when markets are low, in opposed to cash out, when markets are low, in opposed to buying more so that you can ride the wave up. And that isn't, I'm not saying you should definitely go do that, but those are things to actually consider. But it makes no sense in you crystallizing your loss only to go back in at a lower price to hope that you get back up to a higher price on the way back out. You're crystallizing a loss. It makes no sense. Okay. Kev, I normally go longer. I do normally go longer than 45 minutes, but trust, I do have things to do this evening, and I've got I've got a big project on at the minute, which is taking up a lot of my time. All right, someone's asking here, your thoughts on Life Strategy Target Retirement Fund versus 100% Equity World Index Fund. They're two different funds, mate. The Life Strategy which one are you talking about? Because there's 4 life strategies or 5 life strategies. The 100% Equity Index will be pure companies, pure equities, diversified globally. Whereas the Life Strategy will have, if you go not 100%, you go for can't remember which ones they have now, but some of them will have bond allocations in there, which is a good diversifier. So it really depends what you look at. If you're looking at the 100% life strategy, it will be very, very similar to the world equity. I would argue that you'll get a little bit more diversification in the 100% life strategy than the 100% equity index fund, because the life strategy might have the 100% equity world fund that you're talking about there, but it might also have some other ones in there as well. So you get wider diversification potentially. But what I would do is when you go into Vanguard, go and have a look at the portfolio breakdown or the portfolio makeup of the life strategy and compare it with the world index, and have a look at what the composition is when it comes to the companies that it's actually invested in, and then use that as an eye to gauge what companies you're going to have access to, because a lot of the funds would duplicate exposure. So again, you be asking the question, is that necessary? Um, Kevin's asking, have I ever seen 17 Again with Zac Efron? I think I have many years ago. Yeah, I'm pretty sure I have. Uh, Someone saying, is it even worth to have bonds in the portfolio at this stage? I would say yes, because it is a diversifier. Typically, when bonds go down, they won't go down as sharply as equity. And that's the whole point. You want to have a counterbalance to your equity position. That's the role of bonds. And if you are able to get into a bond that has a positive yield right now, well, equities are going down, you have a positive bond yield in a bond, then clearly that's a positive, because you because you're offsetting you're offsetting your losses on the stock market. So it is worthwhile having bonds within your portfolio always. Okay, someone's asking here about an emergency fund. I'm trying to save a bit more in my emergency fund at the moment, but struggling to stick to my savings goal. Do you have any tips or strategies to help with saving money? Okay, yeah. Um, okay, so if you're struggling to stick with your savings goal, I would ask you whether or not you need to review your savings goal specifically. Is it too ambitious? Because look, when you're budgeting and you've got a goal that money needs to go here and you can't stick to that, you need to know why. Why can you not stick to it? Is it because things have increased so much that actually where you were budgeting before just doesn't work? You need to revisit it, you need to rework it. And it's okay to say, if your savings goes down in say £50 a month, right? If you had to cut it down to 45 or 40, that's completely fine. There's nothing wrong with that in doing that. But I would say, revisit your savings goal. And the reason why I say that is because unless you are able to tackle the reason why you're not able to keep to your goal, I could tell you, think about rounding up or, using cash. So this is one thing that I do, right? It's very, very easy to just tap, 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 tap on your card. So on some weeks, what I would do is I would take out cash. So I'll take out cash, could be 100 quid, right? And that £100 has to last me the entire week. If it runs out midweek, tough. I can't use my card. I can't take any further cash out. So those kind of things can help you. If you are not rounding up already, perhaps round up to top you up. So you might be saying, right, each week I'm setting aside £10 towards my £50, whatever it might be. But if you're spending on your card every week as well, rounding up your transactions will give you that additional boost as well. But you need to understand why you're missing your savings target and readjust. That's the one that's going to make you feel um, best psychologically, because you're attacking the reason why you can't. It's like, saying to someone you're really ill, take some paracetamol, but you don't really know why they're ill to prescribe the right thing for them. So try and tackle as to why you're having struggles with it. It could just be, mate, things are tight right now and it's difficult for everyone. It may just mean that you need to reduce the savings goal a little bit, readjust it, or just relook at your budget altogether. I'm just scrolling. Bear me 1 second, guys. Okay, how do I move my stocks and shares account across to a stocks and shares ISA? Okay, so I'm guessing you've got, how do you stocks and shares account across to a stocks and shares ISA? Bumble, can you just give me a bit more context there, mate? So if you've got a stocks and shares account, okay, so you've got a stocks and shares account that is not an ISA. If you've got just like a general investment account invested in the stock market, which is your general stocks and shares ISA, if you want to move that into an ISA, you need to speak to your provider and see if they will just do a transfer of those funds into an ISA account for you. You need to be a little bit careful though, because if you are down, the last thing you want to do is just cash in your losses, then move into an ISA. Yes, you're going to get the tax free benefit, but If you're down, you're again going to crystallize a loss. If you're in a gain, potentially you're going to be triggering a capital gains tax liability, depending on how much you have in there. If you have relatively small amounts, you should be underneath the capital gains allowance, so you don't have to worry. But I'll speak to your provider first, just to see whether they can just do a transfer for you. That will be the first port of call, I would suggest. Ali's just saying here. I'm monitoring an investment flat. I'm after dropped 50K since September. Yeah, I mean prices are coming down massively, massively. So, and again, this is where we talk about the fact that there is a little bit maybe doom and gloom right now. People are very cautious and I guess apprehensive around the extent to which the property market might fall. But if you got cash right now, hey, listen, happy days, mate. This is what you've probably been looking for, waiting for, right? Because as property prices come in, you can snap something up at a really, really, really good deal, at a really good rate, if you have the cash behind you. I mean, I would almost be tempted to look at property if my circumstances change. So it's not always doom and gloom. I think we have to appreciate both sides of the equation because even in times like this, there are opportunities. But you're right. I mean, there are some places that have seen massive, massive falls in property prices. And if you're looking to get on the property ladder or to invest into property, it's an opportunity for sure. Okay, yeah, Bumble just saying you've got a 15K in a investment account. Yeah, so speak to Hargreaves Lansdown, mate. Speak to Hargreaves Lansdown, and they should be able to give you some guidance on how you actually transfer into an ISA. But yeah, just be mindful that if it is already invested, you want to be mindful of crystallizing a loss just to get it into an ISA. So it depends how much you're down by. If you're not down by any amount, then it may be worthwhile doing. But speak to Hargreaves Lansdown; they can guide you. Okay, this is a good question. Do I have any recommendations for minimizing inheritance tax? Yes. Um, Inheritance tax is very, very. There are lots of things you can do, but it's all about picking the right thing for your circumstances. You can have a look at things like trusts to reduce your inheritance tax liability. You've got to go see someone for a trust specifically for that, and they need more details around, how big is the inheritance tax liability going to be. The good thing is that you're asking this question before the event of a death, right? Because people often don't have these conversations early. And then by the time they do have this conversation, they realize that they could have done something, it's way too late. So trusts are one way that you could do it. A life insurance policy is also another thing that you could do potentially to cover the inheritance tax liability upon a death. But again, you need to have a good assessment of all of the assets within the estate and a good calculation. You need as accurate as possible a calculation towards what the inheritance tax liability is going to be. From there, and don't just go buy life insurance policy on comparethemarket.com. You need proper advice to make sure that you get it right. So please seek a professional. If you don't know a professional, then maybe DM me on Instagram. I know a few people who are really, really good at this type of stuff. But yeah, there are lots of things that you can do. Life insurance is one of them, but you need to make sure that you get the right advice to make sure that you're setting up the policy in the right way as well. Trusts are also another way of doing it. If you have a particularly big inheritance tax liability and you have lots of family members, then maybe a trust might be worthwhile doing. But again, you need to take advice because it is a very specialist area. Hey, what's going on, Carly? What's going on? Good to see you on here, mate. Bjorn, let's have a look at this. I've got 160K to invest in property. When would you say is the best time to buy? Look, again, mate, there are a lot of moving parts here. So if you've got 160K, I think for you, the question will be how much of a mortgage do you need? Do you need mortgage? Where do you want to buy? Is 160K going to mean that you can just buy cash outright? If that is the position that you're in, then you probably want to wait for as long as possible to see when you feel right. This is probably the bottom to get in. But it depends on your circumstances. If you still need to take out a mortgage, you're still going to have the equation of what's going to happen with mortgage rates and how does that impact your rental yield if mortgage rates continue to rise. Where is the break even for you? That's where you need to understand. That's if you need a mortgage. If you're buying outright cash, then really you want to buy at the best price possible, and so it becomes a completely different conversation. It's all about the value, how much of a discount you can get on the asking price to increase your yields, pretty much. So it really depends, mate. I would say keep an ear to the market and see um, what transpires. Slee's just saying here, I think the Bank of England will increase rates another 75 bips. Still a lot to go from Hugh and Bailey. Your thoughts? Look, it, it was said in the budget. And listen, when it's said in the budget, and it's one of the first things that the Chancellor says, you bet your bottom dollar, mate. Listen, I think at some point, if inflation doesn't come back down, 0.75 is not the end. We're going to start seeing 1% increments. I genuinely believe that. So they're going to, and they've already signposted, we're going to keep going until we get to the point where we're going to break something. Like they're not saying this stuff out loud for people not to pay attention to. They're, number one, the first thing they're doing is they're signaling to the market, we're going to push and we're going to push really, really hard until something breaks. So be prepared. So hopefully the market can price some of this in so that when the announcement does finally come across, it doesn't catch anyone by surprise and it doesn't spook the markets. That's the reason why they say these things out loud. And they've been saying this now for the last month, maybe even two. The bank rate is going to go up, and I wouldn't be surprised if we see a 1% increase at some point because inflation jumped from what 10.1 to 11.1 the last time we checked. If we see it go up again at the next call, they're going to have to take drastic action. So watch this space. All right, so this is a good question. How do I consolidate my debts if I'm already maxed out already? Okay, so look, it depends on what you've got. So the first thing, you need to think about this from a lender's point of view. When you say maxed out, how are you maxed out? Are you maxed out on credit cards? What are you maxed out on? If you're maxed out on credit cards, then one of the things that you could do to consolidate would be to put all of that credit card debt onto a personal loan because the rate on a personal loan will be cheaper than the interest rate that you're probably paying on the credit cards. You might be in a situation where you've got 3 or 4 credit cards and you can't balance transfer to another credit card because you're not going to get the limit that you need. I'm thinking that's what you mean. So maybe a personal loan might be something that'd be more appropriate at that point. But if you've missed payments, if you've had late payments, if you've had any defaults, you're not going to get a personal loan. So it's really, really important before you start applying for things, you need to be downloading like ClearScore, someone like that, where you can actually see what's on your credit report because the bank are going to have a look at your credit report. And if you've had a missed payment, late payment, anything like that, goodbye. You're not going to be able to get one. So you're going to feel like you're stuck. So you can do a personal loan. If you've got property on a mortgage, you've got equity, that might be another way that you could actually consolidate. But obviously, with a mortgage, you're going to be paying more interest over the long run. It will give you the greatest relief on your monthly payments. But because you might have a mortgage that might run for 10, 15 years, whereas a personal loan, you might be out of it by 5 or 7 years, you're going to pay more interest in the long run. I think it's really, really important to understand that equation. But even with a mortgage, if you've missed payments, late payments, default payments, you might be a little bit stuck. What I would say is this, and I've been in debt. I understand it all too well. And it's horrible. It's stressful. It used to fill me with so much anxiety when I got letters through in the post or when someone would call me from a withheld number, I would freak out. So I know that it's horrible. If you can't consolidate, it's really, really important that you get a look at A4 piece of paper, A4 piece of paper, write everything that you've got in debt down, all of it. Get the current balances, get the current interest rates. And if you can't consolidate, you're going to have to streamline your finances in terms of your expenses to prioritize how you're going to pay down those debts specifically. Again, I'm not taking any coaching calls until like January now because I've got a massive project that I'm working on. I've had so many people email me trying to book in sessions. I just can't at the moment until January. I would offer help, but I wouldn't be able to help and take a look at things properly until January. So, go and have a look at ClearScore first and foremost. Download that. It's completely free if you haven't already. Check out what your credit score is. If you already have ClearScore and you've been using it for a while, if you go on to the personal loan section, they should recommend loans that you have the highest propensity to be accepted for based on your credit score and your credit rating. So um, those are a couple of things for you. But yeah, I know it's horrible. I know what it's like, mate. So hopefully that helps. All right, this is a good question. Can you explain the benefits of investing in an ETF are rather than investing in the top stocks of that ETF? Right, so an ETF will typically have quite a few stocks in it. So you might have an ETF with 50 to 100. Maybe, even on Vanguard, you might have them invested in, 1,000 companies. If you invest in individual companies, it's very, very unlikely that you're going to be able to pick up all of those companies at the same time. And equally, if you're buying individual companies that are in an ETF, which ones do you buy? You can go and buy the top 10, but the problem you're going to have there is you're not going to have the diversification that the ETF has. So not only are you going to be putting yourself at higher risk, you'll think you're buying good companies, and they will be good companies if they're included in an ETF, but you're going to give yourself more exposure to losses because, for example, a lot of the top companies and a lot of ETFs right now are in the tech sector. What's happened to tech? Absolutely tanked. So if you thought, right, I'm going to be clever and just buy the top 10 companies in this particular ETF and it's all tech companies, not only are you down massively right now, you've also got a lot of companies in one sector which is suffering right now. Sectors that are doing well, energy, you won't have them. Banks tend to do really, really well through recessionary and inflationary periods. You won't have any bank stocks in there at all. So with an ETF, you're getting better diversification, better risk management, and you're getting exposure to more companies. And if you said, right, I'm just going to buy the top 10, 15 of an ETF that you've just randomly picked off Vanguard or Hargreaves Lansdown. So there's a reason why they say ETFs, because typically when someone like Vanguard or Hargreaves Lansdown puts together an ETF, they are picking the top 10 companies for a specific reason. They're doing research, they're doing due diligence, and they're making the decision based on, right, this is the information you have access to. We're going to allocate money to these top 10 companies because of the research and the information that they've done, that they've gained access to, and the research that they've done. So I would generally say, in opposed to you trying to pick your own stocks, go ETF, because at least you're going to be reliant on the competence and the efficiency of a professional company knowing what they're doing with a long track history of picking stocks into an ETF or portfolio. Okay, this is a clarification from Abel. I'm wanting to move my fund and share account to stocks and shares as dividend and capital gains taxes are ridiculous. Yeah, I mean, look, I did do a video on this, right? I said that, one of the most valuable accounts that you're going to have right now is ISAs because of what the government has done with capital gains tax and dividend tax. It's a joke. Like literally, if you could see my face that day, I mean, I was literally on channel 4, and they put me in a room with two other people to say, look, we just would love to get your top 3 or top 4 things on the budget, and I could not believe. I mean, to go from 12,300 to £6,000 in 2023, then £3,000 in 2024. That's a kick in the teeth. If anything, I would have thought they'll take it from 12,300 down to 10,000, not half it, then half it again. So over the next 2 tax years, essentially, if you're in any kind of profit on your stocks or your bonds or your crypto or anything, you're getting screwed. And guess what? HMRC, they are going to be investigating people who have made a ton of money on crypto that haven't reported any of this stuff. It's painful, and it does make ISAs one of the key contenders and one of the most important accounts there is right now. Like I said, I did a video on it a couple of weeks ago, and that video's done really, really well. But yeah, ISAs are, I know exactly what you're talking about there, but you need to speak to your provider just to see how the best way for you to move it across from your general investment account is. And so I think you're with Hargreaves Lansdown, so pick up the phone and speak to them. All right, okay. I'm just scrolling. Bear me 1 second. I've got 15 minutes left on this. What's this one? Let's have a look at this. I have a bond, 20 years old, was told to create a discretionary trust. A beneficiary, my sister. Can I remove the trust? If not, what are the taxes? What would the If not, what are the taxes would my sister have to pay if I were to close the account, close the bond account? So you put a bond in trust and you put it in a discretionary trust. You want to remove the trust altogether. Um, you need to see a trust specialist, mate. The thing is, you've got a discretionary trust. So with a discretionary trust, it's not like a bare trust or an absolute trust where you can't make any changes. With a discretionary trust, you can. So you need to, if you still got the details of the person who set up the trust for you, I would just say, look, this is what I want to do. I want to remove the trust altogether. The minute it comes out of the trust, depending what you've got in there, if you're going to cash it in, capital gains tax will apply immediately. Um, Inheritance tax will apply as well at some stage, but I don't know. There's so much that I don't know. But you need to speak to a trust specialist first and foremost. He'll advise you on what best you can do, and then from that point onwards, yeah, there will be taxes the minute it comes out of the trust if you're making any kind of like withdrawals or you're cashing it in, there will be tax to pay. But you need to seek advice from the trust specialist, really, or from a trust specialist. I'm just scrolling, guys. Maybe 1 second. Yeah, someone just saying here, big interest rate hikes are coming just like the US. I would agree with that 100%. Um, there's a good conversation going on here, which I do like. Thank you. Uh, what's this? Your thoughts on dollar milkshake therapy proposed by Brent Johnson, which is what, as major central banks across the world continue to hike rates and tighten, means that the dollar will get stronger. Yeah, I mean, yes. Yeah, I mean, we've seen that. I mean, the dollar is the dominant currency across the world, right? So as interest rates tend to increase, it does help the dollar become a little bit stronger. So yeah, I do agree with that 100%. I mean, there are challenges to the dollar at the moment. There's a lot of stuff that's happened with the whole Russia and China, trying to peg their currencies to the gold standard. That potentially presents a threat to the dollar, but I think that's still some years off at this point in time. But if they succeed, it could be really, really bad. But let's just hope it doesn't happen that way. Yeah. So with this disco, let me just reiterate: please, please, please take advice on the life insurance policy. What you don't want to do is take out a life insurance policy that will have exclusions on there that may apply, and then upon death, it doesn't pay out because there was an exclusion in there that you should have known about at the forefront of taking out the policy. You need to take advice. And if you don't know anyone who can actually do it for you, then let me know. I can put you in touch with a few people, but you do need to take advice because it is a very, very, it's important that you get it right. All right, so someone just saying here, I have two properties I bought in the 1990s. If I sell them now, the CGT will be very big. Is it worth putting them into a company to mitigate IHC long term? See, you can't just do that. To put it into a limited company, you have to sell the properties to a limited company at fair market value. And in selling so, you're going to pay capital gains tax. There is no quick way around this, which is why I always say to people, there is so much hype about property, 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 property. You have to know what you're doing at the outset. You just can't transfer it from your name into a company name. It has to be sold to the company at fair market value. And the minute you sell, you're realizing the gains. You've got to pay capital gains tax on that at 18 or 28%, depending on your tax bracket. So you're going to have to take that bullet, basically. Once it's in the company, then yeah, inheritance tax can be managed, because what you basically do is if you have kids or grandkids you want to pass the portfolio down to, you make them a director of that company, they take salary and dividends from it, and the properties basically belong to the company. But you have to move it from you to the company, and in doing so, there has to be a sale, there has to be a transaction in between, which will trigger capital gains tax. With 300,000, is it better for me to buy a property outright and remortgage than BRR after, or buy multiple properties? I'm not in the investment property place, mate, so I couldn't tell you, if I'm honest. Um, Investment property is not my game. I talk mainly about stock market, that kind of stuff. You need to speak to a property investor, really, who is experienced on BRR, BRRR, in order for them to give you a view. It's not my lane, mate. So I don't profess to, or even try to advise or guide people on something that I don't fully understand myself, unfortunately. Right, 3 loans already at low rates, and also have credit cards available, but just paid them down and I'm using them. I'm also mortgage free. Would you advise remortgage or stay away? Any advice? So the question here is going to be, mate. Okay, so you're mortgage free, so you should have disposable income. Look, if you're going to look at remortgaging, the main equation is going to be how much are you paying on interest on your loans for the 3 loans that you have? What's the monthly payment? Then what would that amount look like if you were to remortgage? And how long do you have left on your mortgage? I mean, if you're going to save a few £100 a month, then it might very much be worthwhile you just put it onto the mortgage, knowing that it's going to be paid down at some point in the future because you've got enough equity in the property. Your loan to value is going to play to your benefit. If you're mortgage free right now, you want to take out something like, I don't know, 50 grand or 30 grand, whatever the debt that you have. There are minimums on mortgages as well, though. So it's also worthwhile remembering that, whether or not you're going to meet the minimum. I don't know how much you have on those 3 loans. But your loan to value is going to be very, very small. So you'll get access to better rates, really attractive rates, actually. So it is worthwhile exploring. If you want to remortgage, speak to a mortgage advisor, look at the numbers, crunch them, because you might be able to save yourself a few £100 a month for sure. All right, someone's saying pension or ISA, where would you put your spare cash, or would you do both? I want 500k in pension plus my defined benefit pension, plus make dividend income on ISA that I want to be around 100 to 200. Okay, so you got a defined benefit pension, which would give you guaranteed. It'll, I see. The thing is, I don't know your numbers on. So if you want 500k, then you want dividends on income from your from your ISAs for about 100. It's 100k, 200k. You want the sum amount to be, so you can get dividends off that. That's going to give you what, 700,000 plus your defined benefit pension, which may kick out X amount. But it will be good to know what that number is going to be on your defined benefits. On top of that, you're going to have your state pension as well. So you're in a really, really good position. The question is, do you need access to the cash right now? Because obviously with a pension, you can't access it until you're 55. So you might be closer to the 55 mark. So if that's a few years away from you, then the benefit of a pension is you're going to get tax relief on the way in at your highest rate. So if you're 45p or 40p rate, then you're going to get that money put back into your pension. So that would make sense to basically do and get that benefit. At 55, you can take 25% of your pension completely tax free. In an ISA, instant access all the way through. So if you're not close to 55 and you might need the access to the money in the next year or two, then ISA would be a better place to put it. But it really depends on your age. Time to 55 really is going to be the big deciding factor here. Do you need access to the money is also another big question. So, but mate, I think you're going to be in a really good position, really, to be honest. I mean, if you did get 500k plus, that's 700k plus your defined benefit, then state pension on top. Happy days, man. Happy days. Someone, Kaz is saying he never missed a payment. Mate, great. Listen, I would have a look at all the options, mate. Listen, speak to a mortgage advisor. and just crunch the numbers and see where it's going to save you money. If it's going to save you like 200-300 quid a month, mate, it's a no brainer. Even if it saves you 100 quid a month, and you think actually it puts you in a better place from a mindset point of view, it's a no brainer. I mean, what's the difference between a personal loan and a mortgage? The interest rate will be very, very different. The mortgage, you can throw it into the long weeds, be paid off. You know you're always going to make your mortgage payments anyway. So, you know, but again, it's all about your circumstance, how you feel about this kind of stuff. If you've never missed a payment, you will get accepted for sure. If you wanted to put it onto the mortgage that is mortgage free with a very, very low loan to value, there is no reason why they would say no, really, unless there's something else in your credit score that um, would negatively impact you. But it doesn't sound like it would. Can you add payments to a fixed rate bond? No, you can't. The amount that you initially put in there is what basically remains in that bond. You'd have to open a separate fixed rate bond for the additional money that you have, which will start the term again, basically. But once your fixed rate bond is in, you can't make withdrawals, you can't add money to it. You're locked in the amount that you open it with for 12 months, 24 months, whatever the term of that fixed rate bond is. I'm just reading the comments, guys. Bear with me 1 second. Oh, good. Oh, no, this is good. Mate, this is really good. Dude, this is a really good position to be in. 1,050 into a company pension, as well as the 500k pension plus 20k guaranteed. Oh, dude, come on, man. You're going to be sweet. This is such a great place to be, mate, because when you factor in your state pension and, you know, the £1,050 that you've got going into your company pension now, you might have a few more years to go towards retirement anyway. Um, yeah, as long as you've got the funds invested in a way that you can manage it, and obviously you need to think about risk here because if you are closer towards your retirement date, let's just say you were 5 years to retirement date, then just risk management becomes really, really important. Even 10 years out, risk management becomes a really big thing that you should be thinking about because the idea is you want to protect what you've amassed already and not leaving it to the whim of the market within your last 10 years. Because if things fall off, market correction, it might take 6 7 years. So you want to start protecting things, but you're going to be in a really, really good position, mate. If you've got 20k guaranteed from a defined benefit, right? You're going to have a state pension on top of that. You're plowing a good portion into your company pension right now, plus 500k. You're going to be really, really good in retirement, depending on what your income requirement will be. But oftentimes, people overestimate what they need in retirement because when you base it on what level of spend you have currently, yes, you've got to factor in inflation. Some people are very, very surprised when they realize actually you don't quite need as much in retirement because you just don't. You're in a really good position though, mate. All right, I'm going to look for one more question. There's a lot of crypto questions here. FTX, yeah, 80,000 UK customers were impacted by that. Coinbase, I did a video talking about Gemini. I think they're going to go pop. Um, I will Coinbase go? I think hopefully they'll be too big. Hopefully they don't. But who knows? Someone saying here HSBC announced a few weeks ago that house prices could drop 15%. I've said this at the beginning of the video. I don't know. I mean, the Office of Budget Responsibility is saying 9%, but they are government agency really. So you could say that they would underestimate or under forecast it. We just don't know, mate. We think we're going to be in a tight spot for property prices, but the OBR is predicted 9% over the next year. Um, how does one set up a trust? You need to go see a trust professional, mate. Just don't go buy one online. You need to make sure that it's fit for your purposes, for what you need them to do. Um, Same thing with life insurance as well. Go and speak to a professional. Just don't go buy one offline. There are lots of things that you can miss. And I know people don't want to pay for services and pay for professionals, but if you don't, you can go set something up that isn't fit for purpose. And then when you really, really need it, it doesn't pay out. It doesn't do the job that you need it to. So you need to speak to professionals. And as Bumblebee saying here, there are lots and lots of exclusions on life insurance policies. If you go buy one with an exclusion that applies to you, you might as well not bought that policy in the first place, and you're just tipping money down the drain. You need to speak to a professional. I cannot stress that enough. Okay, cool. Right, this is going to be my last comment. So let me just check this out really, really quickly. Okay, so the way that you can really help me, obviously you guys have been here for pretty much most of the duration of this. It is now 45 minutes. We're now up on terms of questions. But one of the things that you can help me that will really help the channel is, by smashing the like button. From a YouTube point of view, the algorithm is very, very strange. They will not push this video to anybody else if they don't feel as though the people who are on the stream actually interacted with the stream. So comments as you've put them in, questions as you put them in, they for some reason they should you would think that they account to this, but they don't. So they measure it by likes. So there are about 53 of you still on here at the moment. If we can get this up to about 40, 45, that will be amazing. It takes 1 second. So literally just tap that like button. Much, much appreciated. I used to do these regularly. I'm doing this now because obviously there's a lot of new people on here, and I have a little bit of spare time this evening. I could be spending it doing something else, if I'm completely honest. So, and as I've become more busy, it's just been really, really hard for me to dedicate the time that I spend to do these, and especially on a Sunday evening where my partner generally goes to work early in the morning, and we rarely see each other during the week. This is time that I could spend with her, but I appreciate where we are, and I do want to help people. So this is the one way that you can help is getting it up to up on those likes, and that will just mean that YouTube will push out to other people who may see it as well. I don't know when I'm next going to do one of these. I'm very conscious we're heading towards the end of the year. I mean, look, we're heading into December. I mean, it's been absolutely crazy, and the year's flown by, and it's been amazing. It really, really has. And it's been a milestone year for sure. There's lots and lots of stuff that has been happening. Um, Appreciate every single one of you. People like Kevin, Carly, if you're still on here, Andy, Edna. All of you guys have been on so many of these streams, and you follow me on Instagram as well. Some of you are in my Discord group. I appreciate you guys so much, and I appreciate any one of you who is new, who's only just found the channel. The reason why I do this is because I want to be able to share the knowledge that I've gained through 15 years of working in financial services, stuff that I wish someone had told me when I was in my 20s. I would have made better financial decisions at the end of the day. And I just didn't know to make better financial decisions because I didn't know the information. And so that's what this channel is all about. It's all about sharing my knowledge, putting it into a context, into a format that people can easily digest. And I'm extremely and acutely aware that over the last 2 weeks or so, there has been a lot of backlash around YouTubers who do what I do. I've always tried to ensure that I'm ethical in everything that I do, particularly when it comes down to working with brands, because the big YouTubers are really they're in for it right now, and look, justly so. And I've spoken on it myself, but this year has been an amazing year. This is my full-time job. People sometimes don't appreciate that, and people complain that there are ads in the lives, in the streams, on the videos. Well, that's how I pay my bills. That goes towards me paying my bills. I'm not a millionaire. I've done a lot this year that has kind of upped my profile a little bit. But regardless of how big my profile goes in terms of any TV work that I do, this is still my birthplace. This all started here on this channel. And the support that you guys have given me, particularly all of the regulars that I've just mentioned, the support you guys have given me have gone a very, very long way to getting me to have done all this exciting stuff this year. And I cannot I cannot tell you how grateful I am for the fact that people will spend time with me on a Sunday evening and ask my opinion. And it's never to, you know, tell people exactly what to do, but it is to give you a little nugget from my head that you can use, that you can take to make your own decisions. I've got to be completely upfront. There are some big, big changes coming next year. I'll probably talk about that in the next 3 weeks before Christmas, before the new year. But there are going to be some big, big changes coming to the channel. I don't necessarily know whether I've got them right or whether I will get them wrong. Time will tell. But I feel it's the right thing for me to do based on what I want to do moving forward and where I see the next steps for this channel. So we'll learn a little bit more about that in the coming weeks. I'm working on a really big, exciting project right now, and I've not said anything just yet, but we'll hear. You will hear more about that once we're ready to announce. And yeah, I just want to say thank you for joining me. Thank you for all your questions. I appreciate every single one of you. I hope you found value from this, and thank you for getting those likes up. We're now at 45. Have a good evening, guys. I will speak to you during the week. I'm doing more videos, more lives, because it's just a little bit easier for me tonight. I can be a little bit more reactive with the